With investing, especially when you're managing your own portfolio, it is so vital to do due diligence on stocks ahead of time. Once a stock has had a sudden drop, then you choose to do your due diligence can sometimes be too late. We want to do it ahead of time so we are ready when the opportunities persist. And in today's video, I'm going to fill you in on a little secret. I'm going to be giving you 3 stocks at the top of my watch list. I'm not looking to buy these stocks at today's levels. I'm looking to buy them at a discount, and I'm going to fill you in on the exact price I'm looking to buy these 3 companies. So make sure you stay tuned throughout the entirety of today's video. And before we begin, do me a favor, click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 stocks at the top of my watch list, beginning with watch list stock number 1, which is Intuit, stock ticker INTU. Intuit is one of those pandemic-related companies that saw its stock price surge up to as high as $680. But since then, we haven't seen those highs yet again, at least not yet. For those of you unaware, Intuit serves a large client base of small and medium-sized businesses, with many of its different offerings from QuickBooks to TurboTax, MailChimp, and many more. The company currently has a market cap of $176 billion, and over the past 12 months, shares are up 14%. But for 2024, the stock has gone nowhere, up only 0.3%. So what is the deal? Well, there's a number of reasons to be both concerned and excited about Intuit moving forward. Intuit happens to do well when many small and medium-sized businesses do well. But when the economy is struggling, Intuit shares could struggle as well. So right now we're looking at an economy that has seen slowing growth, a labor force that has started to show some cracking. But on the horizon, starting this very month, we're going to have interest rates start to come down. What is that bullish for? Small and medium-sized companies. So there's reasons on both sides of the aisle to be both concerned and excited about Intuit moving forward. Looking here, you can see the earnings estimates for the next few years as it pertains to the company. Analysts are expecting $19.34 per share in EPS for 2025, which equates to a forward price to earnings multiple of 31.8 times. Over the past 5 years, shares have traded closer to 37 times, which is also in line with their 10-year average. However, is the company growing as fast as it once did? No. So they probably do not deserve that high of a multiple anymore, but earnings are still growing 15% the next few years. When I look at other multiples from a cash flow perspective or even from an EBITDA perspective, they just look fairly valued. And when it comes to me buying stocks, I don't like to buy fairly valued stocks. I want to buy high quality companies at a discount. So what price might I want to buy shares of Intuit, you might ask? I'm so glad you did. When it comes to Intuit, I'm waiting for a price closer to $575, roughly $100 per share below today's price, which may seem like a lot, but it's only about a 15% decline from today's prices. So let's continue to keep a close eye on Intuit moving forward. And that brings us to watch list stock number 2, which is going to be Advanced Micro Devices, stock ticker AMD. And when you think about AI and the boom in AI, there's 2 companies that you usually think of: NVIDIA and AMD. There's a slew of others that you could think of as well, but in terms of chips, these are 2 of the leaders here. However, great companies with great management teams like to take advantage of opportunities they are given. And Intel, continuing to fumble over itself, AMD has taken that opportunity. However, shares have been on a downward trend, falling 30% over the past 6 months and down 40% off their 52-week highs. The company currently has a market cap of $224 billion, but over the past 12 months, shares are still up 30%. When it comes to AMD, they have a lot higher demand as it pertains to CPUs, and with personal computers really falling flat and hopefully bottoming out, AMD should see a further uptick the next few years with many AI-compatible computers coming out. In addition, they have seen amazing growth from the likes of data centers, as has Nvidia. But what price are we looking to pay when it comes to AMD shares? As you can see here, analysts are expecting the company to generate EPS of $5.41 per share next year, growing 60% and 35% the following year. So still tons of growth left moving forward. That gives shares a forward PE multiple of 24.8 times and a PEG ratio below 1, which is something I love to see as an investor, especially when looking at growth stocks. This is a company and a stock that I'm really looking to nibble at because the valuation isn't all that extended anymore. But the approach I'm going to take is from an options standpoint. I'm going to be looking to enter a position through cash secured puts. So when it comes to options and choosing a strike price, I'm probably going to be selling a cash secured put around a $115 share price. That's where I would like to buy these shares at, which is about a 15% decline from today's levels. And if I could buy there, I would be happy to and would love it from a valuation perspective as well. But I may nibble prior to that. And that brings us to watchlist stock number 3, which is Salesforce, stock ticker CRM. Salesforce investors have been on a roller coaster, a wild goose hunt. You've seen shares go up, then the June report came out, and the bottom just fell out. But they did rebound in their latest earnings report, and they have clawed back some of those losses they have seen through the first half of the year. Salesforce currently has a market cap of $235 billion, and over the past 12 months, shares are only up 9%, making it the worst performing stock of the 3 that we've looked at today. So as you could see, shares of Salesforce have been the worst performing, but they also might be the biggest bargain of the 3 stocks that we're looking at here today. And as you can see, all 3 companies operate out of the technology sector, one that has been a little bit stretched, but we've seen those valuations come in the past 2 months with underperformance from that sector. So it's an area that I'm looking to be a little bit more patient on right now. But when it comes to Salesforce, again, the valuation's looking great. And this is a company that, although growth is slowing, it's not as fast as it once did, this is a company that is still printing money. Their free cash flow has been growing at a rate of 20% year over year, which again, I love to see free cash flow growth, more so than I like to see revenue growth. Looking here, you could see analyst estimates for the next few years. And next year, the company is expected to produce earnings of $11.16 per share, which would equate to a 10.5% growth rate and giving the stock a forward PE of just 21.9 times, extremely low for a company of this stature. This is the stock that is likely closest to me buying of the 3 that we've looked at here today. So if we go from valuation over to technicals, from a technical standpoint, shares are still going through a bit of a wedge pattern. So there's still some room for consolidation to take place. But the RSI, which is another indicator I like to look at, is approaching around 30, which is an ideal time to enter a position. So in terms of a buy price, I may nibble here very soon at this stock, but likely I will be selling puts very similar to the AMD approach around a 230 strike price or even a 220 level, which would be ideal from a valuation and technical perspective. So there we just looked at 3 companies, all of them operating out of the technology sector. But all of them aren't necessarily something I'm running at from a valuation perspective. Some of them I'm really close to buying, but I want to remain patient. And I'm doing my due diligence ahead of time so that if we get any of those opportunities, which we saw at the start of August and we have seen at the start of September, I'm ready to pounce. And that's why it's so important to perform your due diligence ahead of time. Down in the comments section below, let me know, what are 3 stocks highest on your watch list right now? Is it any of these 3? Or is it another few stocks? Let me know down there. And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.